This topic, taxation of expatriate, is extremely useful topic for all practitioners, and especially with as Hina pointed out, in COVID times, there are specific problems that are arising when people are stuck in different countries despite wanting to travel to their home country. And so what would be the implications? And I'm sure Kush will touch upon that also. And in general terms, even in pre-COVID times, and I'm hopeful post-COVID times, with cross-border trade increasing by leaps and bounds, this topic is extremely relevant to all practitioners of international tax, because expats and movement of people and the tax implications surrounding them. Especially again, the definition of resident in India has undergone a tremendous change in the last year. There have been two categories of resident additionally introduced, and that has again will have some implications for expats and their taxation. So I'm looking forward eagerly to hearing Kush. Kush is a young professional, but who is picked up very, very fast. He has already spoken and written at number of forums, and his articles and presentations have been appreciated by a lot of seniors. So we have an an exciting time ahead for us the next 2 hours. So with these few words, the way I'm planning to present is that we'll allow Kush to complete his presentation, because I find he has around 56 slides in these 2 hours. And then I will request him to keep, and of course, everybody can keep asking queries on the chat box, and I will go through them. And at the end of the session, maybe 15 or 20 minutes time permitting, Kush, we could take up all the important questions so that everybody gets to take home some of their queries answered. I hope that should be acceptable to all. And with these words, am I okay, Rajesh? Is that okay with you?
Yes, sir. Absolutely fine.
Yeah. So with that, I request Kush to take up his presentation.
Thank you, Sushil sir. Thank you to the chamber for giving me this opportunity to speak here today. I think, and thank you, Hina, for introducing me so nicely. As you mentioned, Sushil sir has in fact written a book on expat taxation. So I think he's the perfect chairperson to have, on this session. Yeah. So expat taxation, as Sushil sir mentioned, is a very interesting topic. And while preparing for this, he mentioned that I have 56 slides. And while preparing, I realized that it's not as simple as it looks on its face when you think that, okay, what is there in taxation of expats? But the more I read, the more small nuances and issues I could find. And in the end, I had to kind of pick and choose what to keep in the presentation and what to kind of leave out. So hopefully I'll cover most of the queries that would arise as the session goes on. And yeah, so I'll just start with that now. The coverage I'll take you through the residential status determination first, and then going on to the scope and the general taxation, including double taxation avoidance agreement impacts, and then come to the taxation of specific components of the salary, and lastly ending with withholding tax issues and other small issues which are there in relation to expat taxation. So firstly, what is an expatriate? So there's no definition in the Indian tax law, but an expatriate, the original word, means out of country. It's a Latin word which means out of country. And employees who are working in a country other than their native country are referred to as expats or expatriates. Usually it refers to an employee who's working abroad and who comes into a country to work there for a short period without intending to become a permanent resident. So it's different from emigration or shifting base. It's considered to be for a temporary period. So normally NRIs who go outside India to work would be considered expats from an Indian perspective, or Indians working abroad, and they would be the outbound employees. And similarly, the inbound expatriates would be people from other countries who are coming to work in India. This could be both for Indian companies, because now we have we have a lot of unicorns, we have a lot of big MNCs which are headquartered in India as well. So it could have you could have expats working for them, or you could have local subsidiaries or branches or offices of foreign companies which depute or place their foreign employees in India. As Sushil sir mentioned, the residential status section 6 has gone a change recently, and I've just put this in the slide so that when eventually the slides are shared with everyone, the provisions are there. But I'll go to the summary which I've prepared. So I'm covering the residential status in this way. Firstly, you can look at residential status for people who are Indian citizens or PIOs, including those who are visiting India or they leave India during the current year for the purposes of employment. So this does not include Indians who leave India for the purpose other than employment during the year. For them, the 183-day category is common throughout all persons, all individuals, and the 2 out of 10 or 730 days they become a resident or RNOR. The change which has come in is that now if the income from other than foreign sources is more than 15 lakhs, then the 60-day exemption which was there and where 60 days was to be read as 182 days is now to be read as 120 days. So if a person with more than 15 lakhs of Indian source income stays in India for more than 120 days in the year and has a stay of 365 days or more in the last 4 years, he would directly be considered a RNOR. And if a person is say less than 120 days or less than 365 days in total, or say his income is less than 15 lakhs from Indian sources and his stay is less than 183 days, they will become a non-resident. Coming to people other than Indian citizens or PIOs, and including Indian citizens or persons of Indian origin who leave India during the year for purposes other than employment. So this is 2 categories of people: non-Indian citizens and Indian citizens who leave India during the year for purposes other than employment. So in these for these people, the income from Indian sources is not relevant. It's simply 183 days or more, or 60 days or more, and 365 days or more in the last 4 years. That makes them a resident. And then the second condition in section 6 subclause 6 has to be taken a look at of 2 years if they're resident for 2 years out of the last 10 years, or and if their stay in India is more than 730 days in the last 7 years, they become ordinary residents, or if not, then they are RNOR. And if their stay is less than 183 days and less than 60 days, or less than 60 days, it's more than 60 days but less than 365 days in the last 4 years, then they're directly non-residents. So why the difference why have I categorized in 2 parts is because I'll come to that just after this stateless, the new clause which has come in 6(1)(a), which is for stateless persons. Basically, the government felt that people were managing their period of stay in India, and they were taking up residence in countries like Dubai, UAE, where there is no tax. So there was double non-taxation because they were residents of countries where there is no tax levied on any income, and they were staying in India for less than 183 days and taking advantage of being Indian citizens or PIOs and saying that we're coming to visit in India, so the 60-day condition has to be read as 180 days. So even by staying for 180 days in India the year, they were saving themselves from most of the tax liabilities. So to deal with such classes of persons, 6(1)(a) was inserted to say that a citizen of India, so it doesn't apply to PIOs, only to a citizen of India, and having the total income from other than foreign sources more than 15 lakhs will be deemed to be a resident in India. If such person is not liable to tax in any other country or territory by reason of domicile or residence or any other similar criteria. So if a person is a resident of a country where there is no tax levy and he is an Indian citizen, then the government could extend the residency criteria by deeming him to be a resident in India. And obviously they've clarified that if a person becomes a resident under 6(1)(a), he will directly become RNOR, not he cannot become an ordinary resident even if he fulfills the criteria of 6(6). There's also an explanation which clarifies that if a person becomes a resident under 6.1, then 6.1a will not apply, because there's a chance that someone becomes a resident under 6.1a that could override 6.1, because 6.1a starts with a non-obstant clause. Interestingly, the term liable, the requirement for becoming a deemed resident is that he should not be liable to tax in any other country. And this was a controversy which was there, which was not exactly put to rest, but there was some answer given to this by putting the definition of liable to tax. But there is still some controversy on that. So this particular clause has an additional scope for a person, an expat, becoming a resident in India if such person is staying outside India. And this is more relevant for outbound expatriates. So they're staying in a country where there is no tax, and they have Indian income more than 15 lakhs, then they could be deemed to be a resident in India.
Kush, I'll just take a minute here on this term liable to tax, the definition. The issue which arises is whether a person who is in UAE, where there is no taxation today, whether he is still liable to tax as per this definition. And to my mind, yes, he will still be liable to tax, because there was a decree in the UAE under which that income tax has been kept in abeyance, and that can be any time invoked. So I believe he will continue to remain liable to tax. And so this 6.1a may not apply to those individuals, is my view, unless you want to say something different or have a
No, I totally agree, because there the difference is that they are first subjected to tax, but then, as you said, the law has been put in abeyance. So they are liable to tax, but then they have been exempted after that. So the law, if there is an incidence of tax and then an exemption, you will still be considered to be liable to tax.
Right. You can continue. Yeah.
Coming to the reason why I had dealt with residential status in two parts was that explanation 1, which has two parts, A and B, to section 6.1, says that the 60 days and 365-day condition shall not apply to an Indian citizen who leaves the country for the purpose of employment outside India, or as a member of a crew or an Indian ship. Now, there are a lot of interesting issues which arise from the wordings of this explanation and from the application of this explanation. One is that I'll go back to the section itself. If you look at explanation 1A, it says, in case of an individual being a citizen of India who leaves India in any previous year. So the person could be leaving India any previous year, not necessarily the year in which you're looking at, as a member of the crew of an Indian ship as defined in clause 18. That's the definition of a ship. Or for the purposes of employment outside India, the provisions of subclause C shall apply in relation to that year. That means the year in which he's leaving India, not in a subsequent year. As if for the word 60 days occurring therein, the words 182 days has been substituted. So one question is that when the person is leaving in India, does it necessarily mean that he had to be unemployed when he left so that he went there for new employment? Or is it okay if the person was already employed? So this question was answered in the case of British Gas India Private Limited, where it was clarified that leaving India for the purpose of employment outside India are the wordings which are used, not leaving India for employment. So whether or not a person is already employed, unemployed, the employer outside India is the same employer as the employer in India, or it's a new employer, it is not relevant. As long as the purpose for leaving the country is for employment, for the purposes of employment, not in connection with employment, but for the purposes of employment outside India, this explanation will apply. And why the definition, why the wordings is not in connection with employment? Because this situation or this explanation will not include those cases where an employee who's an employee of an Indian company or an Indian employer leaves India for, say, a tour in connection with employment, and automatically the condition of 60 days will not be replaced with 182 days, because he's not gone for the purposes of employment, but in connection with his existing employment in India. In the case of Ram Sagar Chaudhary, Bangalore ITAT, it was also clarified that an individual who leaves India on deputation, not necessarily changing his employment, and also not in connection with employment, but for the purpose of employment with a new employer, whether that's a legal employer or an economic employer is different, but at least he's leaving the country for employment with an employer outside India. So he would also be covered or have eligibility for this explanation and allowing to be governed under 182 days instead of 60 days. Another case was, does employment outside India refer to posting, temporary posting? So that's similar to the previous question, where it was clarified that foreign tours do not imply employment outside India. There has to be some degree of permanence or long-term in nature for it to be considered employment outside India instead of in connection with employment, which is subsisting in India. It was also clarified for this purpose that an employee would also cover consultants and technicians when the case was being examined for the purpose of Section 80 RRA, which spoke about standard deductions which consultants or technicians earn from foreign contracts. So there it was clarified that even if a person, say, is a consultant or a technician and he's going outside for his own work, he would still be considered an employee and therefore going outside for the purpose of employment. So he would also be able to take benefit of this explanation and be governed by 182 days instead of 60 days. Another interesting cases which are there is how to determine how many days someone has stayed in India. So there are a lot of opinions on this and there are a lot of views on this, but most of the judicial precedents which we have, it says that if starting with the Gautam Banerjee case, that if a person arrives in India, in this case, if the person arrived in India, he was working on an oil rig and he used to arrive in India after working on that particular day, the last available flight, and would reach India between 9 o'clock and 12 a.m. at night. So the ITAT held that it's highly unlikely and that the person would actually do anything productive on reaching India. So you could not include the day of arrival simply because it was at the fag end of the day. And in that case, the person's stay, if you counted each day of arrival, was around 187 days. But after excluding the days of arrival when the person arrived late at night or left the country early in the morning at 4 a.m. with a 4 a.m. flight, because as he was working on an oil rig, he would leave early in the morning and also start working there the next day. So by excluding those portions where only a small part of the day there was presence in India, his stay became less than 182 days and he was held to be a non-resident. In a separate case, in two cases, in fact, it was held that the day of arrival, irrespective of how long you stay on that day, even if you arrive in the morning, is to be excluded while calculating the number of days. And a similar judgment was there by Jaipur ITAT, which said that only the date of departure should be considered as in India. So there's clarity that the day of arrival shouldn't be considered and the day of departure only should be considered. There is an advance ruling which is contrary, which says that both days should be counted, although there are enough precedents which override that. But again, if the logic of the Gautam Banerjee case is taken and the person arrives in India very early in the morning and leaves on just before 12 a.m. midnight, it may be reasonable to include both days, even if there are other decisions which say otherwise, because the person's physical presence would allow him to exercise employment or conduct his affairs in India on those days. The OECD commentary says that both days, including arrival and departure, are to be included. Even Klaus-Vogel has the same opinion. The OECD commentary goes further to clarify that all days spent in the country are to be considered, including holidays, non-working days, whether that is before the work began or after the work began, sick days. But it says that days in transit and any days which are spent wholly outside the country are to be ignored. There's also a clarification which says that if there are sick days which prevent a person from leaving the country because of the sickness, although there was intention to leave the country, and that causes the person to lose his non-resident status, then those days should be excluded, because the only reason why that person stayed in India or stayed in the country for longer than expected was because of the sickness. So the sickness was extenuating circumstances which forced him to stay in India. And this clarification is very relevant from the scenario we've seen in 2020 and even this year. Although the employee himself may not be sick, but they can take the recourse to the commentary and say that they were forced to stay in India for reasons beyond their control, and they had every intention to leave the country. So cases where borderline stay is causing you to become a resident, although you wanted to leave the country, but lockdown forced you to stay in the country. Recourse could be taken to this explanation in the OECD commentary to kind of exclude those days where you were forced to stay in India.
Kush, I think your slide, yeah, no, yeah, okay.
Yeah. A further issue is that whether the term visit for the purpose of explanation 1B, where a person who is an Indian citizen visits India. So whether the term visit would include periods of visit when they say an overseas assignment. So say if I leave the country in a particular year, so I have considered to be leaving the country for the purpose of employment. Now in the next financial year, I will already be a non-resident staying outside India, exercising employment outside India. And because I'll be an Indian citizen or a PIO, when I come to India for a visit, I'll be in the category of a person visiting India. And even under explanation 1B, I would use 182 days instead of 60 days. So in this case, would a visit include any category of visit? Would it be official visits, business visits, or only personal visits? So this issue has been decided that normally visit includes the purpose of visit has not been mentioned in the explanation. It just says visit. So the purpose of increasing this 60-day threshold to 182 days, earlier there was no exclusion, but then the government increased it to 150 days and subsequently to 182 days, so as to allow non-residents and especially Indian citizens who are staying abroad to manage their affairs in India without becoming residents. So based on that reason for which this explanation was added, and the fact that the term mentioned is only visit, not visit for personal purposes, any kind of visit is to be considered. So whether they're coming even as part of their employment, say for a temporary period, 10-15 days, even that should not be counted as something which is done for the purpose of employment. It should be considered a visit and excluded from the number of days which they're staying in India. The second issue is that if in the case of explanation 1B, say an employee leaves India for a particular purpose. So in that case, explanation 1A would apply, where 60 days would not be considered and 182 days would be considered. But what happens if such employee comes back to India in the same year and then cancels his employment, or his employment is terminated? Would it be considered that this employee left India for the purpose of employment? So the explanation doesn't say anything about then coming back in the same year. So what happens in such a situation? So there was a case of Smita Anand where the AAR clarified that the benefit of explanation 1B, that is coming back for a visit, to an employee who shifts back after giving up employment, is not available. So if I come back to India while I'm on employment and I leave my employment, then I cannot say that the 60-day criteria should not apply to me, because I'm no longer in employment and my reason for coming back wasn't a visit, because a visit implies the intention to come and then go back. But if I come with the intention of permanently staying in India, it's not a visit, it's stay in India, and that entire period has to be considered, and the 60-day criteria will apply, not the 182-day criteria. A similar situation was where if there was a person who was an employee of a US company, and he had left the country for purposes of employment with a US company, and he was visiting India. Now, what happened is that because of his period of stay in India, the visit in India, along with his other stay, he was becoming a resident under the 182-day criteria. But the argument taken was that if a person is in India for 120 days and that person doesn't become a resident because they're coming for a visit, but if they come for a visit for 30 days and then they stay for 60 days after that, after giving up their employment, they would become a resident. So although the days of stay in India is the same, in one situation you're becoming a resident, in one situation you're not becoming a resident. So the argument of the assessee was that if I'm coming for a visit in India, and I'm still becoming a resident because of 180 days crossing, that 60-day period should not be included in my stay. And my stay should be considered to be 180, say 190 days minus 60 days, only 130 days. And the Bangalore ITAT, which was affirmed by the Karnataka High Court, agreed with this contention. And they stated that if an outbound individual visits India, then for the purpose of calculating the days of stay, that 60 days should be excluded if that is the reason why he's becoming a resident of India. Coming to residential status and DTAAs, so this is important in case of people who have come to India for work in a particular year, and they could be becoming dual residents because they were in the country, their home country, for a particular period, and they're also in India for a while. Or even in the reverse case, where an Indian taxpayer, normally an Indian taxpayer, leaves the country in the middle of the financial year. So there could be a case where he's a resident of both countries. So most DTAAs do not prescribe the residential status criteria, with the exception of India, UAE, and India, Hong Kong. They merely say that the domestic law definition will apply, and they say that the residence should be determined on the basis of domicile or physical presence, and the domestic law applies. And if a person is a resident of two countries, a dual resident, then in such cases there's a hierarchical tiebreaker test which is prescribed, except in the Japan-India DTAA, where there's no tiebreaker. Directly mandatory arbitration is the way to resolve a case of dual residency. In absence of a DTAA, a person may become taxable in both countries because of dual residency, but in that case, unilateral relief may be granted in either or both of the countries, depending on where the source of income is and where the residency is. For applying the relevant DTAA, it is important to see the employee's residential status, not the employer's residential status, because it is the employee's income which is being considered, not the employer's income. So the tiebreaker test rule which applies is a hierarchical test. It has to be applied sequentially. Say if a person is a resident of two countries, the first test which is seen is to see where he has a permanent home. And the concept of permanent home is somewhat similar to the concept of fixed place of business, which is that there's a disposal test which has to be seen. So even a house which is on rent, for example, or say a house which is owned by the relatives, say the parents of the person, but where a person regularly stays, and say that's the childhood home. So even such a place would be a permanent home. It does not necessarily have to be a place where a person is owning it. But as long as the place is available to the person when he comes to India or to the other country, it would be considered a permanent home. There was an interesting case where employer was going to Abu Dhabi and argued that he didn't have a permanent home in Abu Dhabi. But the courts argued that because a foreign citizen cannot buy property in Abu Dhabi, there's no question of him owning a house. And the house which is provided to such person by his employer was to be considered the permanent home. It could so happen that a person has a permanent home in both countries. Say if you travel outside and you purchase a house there because you're going to stay there for 5 years or 7 years, and you keep your house which is there in your home country because you frequently visit, or maybe your parents or your spouse or your children or other family members are still in your home country. So you could end up in a situation where you have a permanent home in both countries or in neither country. So if this is the case, then the second test is applied, which is the center of vital interest. This looks at a case where you look at the personal and economic relations and determine that where does the person who's a dual resident, where is the affinity of that person greater. So if the person has economic relations or his center of economic interests are mainly in the home country because all his investments are there, all his bank accounts are there, or his personal ties are greater, his family is there, or his entire social circle is there. Even the people look at whether or not club memberships are there, driving licenses are there, whether he has given up memberships of various associations. So various factors are taken a look at to see whether the person's personal and economic relations are greater in country A or country B, because that would determine or indicate the intention of the person of where he intends to reside on a more permanent basis and where he's residing just for the purpose of employment or work or some other purpose. The OECD commentary does not talk about giving preference to either of the personal or economic relations. So if say a person's personal relations are better in a particular country and but the economic relations are stronger in the other country, there's no preference which is given, but has to be taken on a holistic basis. And overall, what is more important has to be given more weightage to for determining or breaking the tie in a dual residence case. But it also often happens that if a person has stayed outside the country for a long duration, 5 years, 7 years, then often the spouse, accompanies such a person, or even the children and spouse go, but then the parents and other family members are in the country, or the investments are built up in the other country after over a period of stay. So economic and personal interest could become shared between the two countries. Then the next step is to look at the habitual abode. This indicates that where a person has habit or habitually exercises his stay, and if a person has a permanent home, but say he goes to a particular country and lives in different places, say that he only comes back to India, for example, for visiting family, visiting friends, or for tourism purposes, then there cannot be said to be habitual abode in India. But if a person comes and regularly stays in a particular place, even though it may not be a permanent home, or it could be a permanent home, in both cases, the habit and the intention of the employee or the person to repeat and regularly be in a particular place would determine where the person's habitual abode is. But it also could happen that the habitual abode could be in both places, because if you're in India and outside India for a similar period of time, 6 months and 6 months, or 7 months and 5 months, and each time you're in the country, you're there in a similar place. If you're in the US, say for example, you're in the US in your house where you're working, and when you come back to India, you're also in your house where you normally stay. So your habitual abode could also be in both countries, or it could be that you've sold your house in your home country, and you don't have a permanent house in the host country, and you habitually reside. There is no habitual basis for your staying in a particular country, because the nature of your job could be such that people could be freelancers, or they could travel for their employment or their business purposes, and they may not have a habitual abode in any particular place. So the last test would then be to see the nationality of such persons. If the other three tests either are not conclusive in favor of either of the two countries, then the final decision making point would be nationality. And although India doesn't allow dual citizenship, but countries which allow dual citizenship, there could be a case where a person is a dual citizen. So then there would be, even the nationality test would fail, and you would have to go to NAP to resolve and break the tie. Or it could also be that a person is national of neither country. Say a person people have passports of different countries, but they actually reside in and they stay in a different country, especially in continental Europe, where a person may be a citizen of Belgium, but is residing predominantly in Germany, and then is traveling to, say, the United Kingdom for work, and has taken up has a nationality of either UK or Germany. So then that kind of case would be a case where the nationality test doesn't apply. Lastly, then you will go to MAP, where the competent authorities of both countries would look at the facts holistically and take a decision of where to break the tie and how to allocate the tax index.
Kush, before we move ahead, there are a couple of questions in the Q&A box, and there are some members who would want to raise hand. Do you want to take it up at this stage, or you would want to finish it first, and thereafter we should open up for questions?
I think, Hina, the questions that have been asked, the first two questions relate to COVID-related issues, which I think Kush is going to cover in his presentation. And so these two questions may get answered during that time. And the third question is about shifting expenses of furniture of an expat on the payroll of Indian company from Indian to foreign company incurred by them will be treated as a perquisite in the hands of expat. Can Indian company claim it as a business expenditure? Now, this goes beyond the scope of the presentation. But we are talking about taxation of the expat and not taxation of the company as such, the Indian company. Now, the question relates to deductibility of such expenditure. And I don't think that is part of this presentation. So I would request Kush to continue in the interest of time. And when we come to the COVID issues, that time, Kush, you can just keep the first two queries in mind and then maybe address them.
I think that's the next slide. So,
Sure.
Okay.
Thanks.
yeah, thank you. So now we come to the interesting case of split residency, where it's extension of the dual residency concept, where a person is say there was a case of Raman Chopra versus DCIT IT decision, where the assessee came to India in July of 2010, and he was a resident as of the US as per the US tax laws and as per the DTAA for the period April to June 2010. So this person was in employment in the US from April to June 2010, and he came to India for employment in July 2010. This caused him to be a resident and ordinary resident for FY 2010-11, and a US resident for 2010. So the ITAT clarified that in this particular case, because after applying the test, they held that for the period before July, before the person came to India, he would be considered a resident of the US. And then for the period after July till March 2011, he would be considered a resident of India. So the income of this person for the period April to June would be taxed as if he were a US resident. So he would not pay tax on that in India. And for the period July 2010 to March 2011, he would be considered an Indian resident. So not only did they broke the tie for a specific period instead of for the entire financial year. And a similar view was upheld by the Bangalore ITAT in the case of Sanjeev Kumar Rajan. So interestingly, there was a dual residency, and it was not split equally. It was not decided for the entirety of the year whether he would be a resident of USA or a resident of India, but the residency was split within a financial year. The OECD model commentary has clarification on this. I'll just quickly read it out. It says that the special rules will apply to those existing periods where a residence affects the liability of tax, where such period is less than the entire taxable period, which is in this case April to June and not April to March. So for example, it says that if in one calendar year an individual is resident of state A under that state's laws from January to March, and then moves to state B, and because he stays in state B for more than 183 days, he'll be treated as a resident of state B as well. So applying the special rule, the period Jan to March should be considered a residence of state A, and thereafter A and B both should treat the individual a resident for state B, because April to December onwards he will be a resident of state B, because as per the domestic law he would be a resident there because the stay is more than 180 days. So another interesting case on splitting residency within the same year. Coming to the topic of COVID, I think this is something which is on everyone's mind. We all know well that in May 2020, it was a pleasant surprise to everyone that the CBDT committed to issuing a circular to exclude the stay in India up till the point of international flights normalizing. They had excluded some part of the stay in the last part of March 2020 for FY 1920, and everyone's expectation was that for 2021 also the similar exclusion, carve out or relaxation will be given. And there was the press release which was on I think 9th May 2020 said that yes, in due course a circular would be issued giving relief. However, the circular was issued quite delayed in March 2021, which was already after some normalization in flights, not completely, but some parts of the world you could travel, some parts of the world you could not travel. And this circular did not give any exclusion or did not give any relaxation to the accidental residents of 2020-2021. And the CBDT circular spoke about the fact that there is a chance that there's no chance of a short stay in India, or that a person who's staying in India could become if there's an exclusion which is given, he could become liable to tax in no country. So there could be double non-taxation, or saying that a dual residency situation would be resolved through the tiebreaker test, and various other arguments was given to justify them not giving any exclusion. They also referenced heavily to the OECD April 2020 guidance and not the Jan 2021 guidance, which was much closer to the situation where they issued the circular. So they reference the OECD April 2020 guidance saying that even the OECD has accepted that the chances of double taxation or inappropriate taxation are lower as compared to what we are seeing. But the Jan 2021 OECD guidance, which was there, did recognize that several countries have given exclusions, including Australia, Austria, USA, Canada. They have given exclusion for time for people because for the period they were stuck in a particular country, although they did not intend to, if such stay in the country was only due to COVID lockdowns. So there are two another point was that the resolution of dual residency to DTAA was mentioned by the CBDT, but that puts the onus of doing all the hard work onto the taxpayer and the taxpayers consultants and the taxpayers team. Instead of the CBDT giving relief to a wider class of people, it puts the onus on, again, the assessing officer to look at each and every case. So that kind of increases the compliance burden all around and the administrative burden all around. The circular stated that applications can be made to the CBDT either for an individual purpose or representations. And the CBDT said it would consider if any general relaxation needs to be provided or if a specific relaxation is required to be provided for individual cases. But so far, we've not seen anything. I'm sure there will be litigation, and I think the Supreme Court already had given a judgment directing the CBD to issue a circular, after which the Circular 2 of 2021 was issued. So probably it'll be the Supreme Court which will eventually grant relief. Coming to the fact that whether or what would happen to such people. So one argument which is there is the doctrine of legitimate expectations, which the Supreme Court has laid out in a case, Ram Pravesh Singh versus the state of Bihar, where what the court held that if a government promises to do something, or it makes an offer or makes a statement that it will give a particular benefit or it will remove a particular obstacle, then there is a legitimate expectation that the government goes through with such an offer or such a statement and comes through and gives the benefit which it had promised to give. So going back to the circular, which said that a circular would be issued in due course to exclude a particular stay, it shows that the taxpayers had a legitimate expectation to expect such an exclusion or a carve out because it had been promised to them by the CBDT. And an argument can be made that if the CBDT had said that no, we are not going to give any exclusion or carve out, then the taxpayers would have probably made more efforts to leave the country, even though there was a lockdown, and it may not have been practically feasible or even advisable to do so. So even if you can travel because there are no restrictions, but if it's not advisable from a health perspective, can a person be compelled to leave the country where it's not safe to do so just to avoid residency? So from that perspective, there's an argument to be made for demanding or expecting relaxation from the government. And the other case is the case of the Delhi High Court, where CIT versus Suresh Nanda, where it was held that an involuntary period of stay cannot be counted in the physical presence in India for determining residential status, simply because you cannot force a person to stay in a particular country beyond his or her will in a force majeure situation, and then also go and tax that person as a resident, although there was no intention to be a resident. And using this very logic of involuntary stay, several countries have given relaxations, but nothing came about from India.
Yeah, Kush, now coming to the two specific queries.
Questions, yes.
Let me just summarize the questions.
Sure.
And these are really relevant. That's why I think we should spend some time on this.
Sure.
Now, there is the senior citizen who is an Indian resident. He is a retired MD of an Indian company. He went to UK to visit his daughter in December 19. And since then, he's in UK and could not return back to India. He is getting pension exceeding 15 lakhs per year from his former employer in India, in addition to other investment income. Now, what is his residential status and taxability of the pension income? Now, here, there are, of course, 2 or 3 issues which arise. One is, now, by physical stay, now to say that since December 19, honestly, there were flights available and it was possible to return back.
Correct.
But for whatever reasons, maybe his children did not want him to take the risk of travel. Maybe for whatever reason,
Correct.
he was not able to come back. And, so in such a case, now the risk is that he will be a non-resident of India because he has just not been in India for the entire year. Though he has income exceeding 15 lakhs, I don't think that is relevant because that is coming into question only if you have more than 120 days in India, which is not the case here.
Yes.
But he would like to be treated as a resident is what I would believe from the question. And in which case he should apply to the CBDT under that circular. This is a genuine case and he should apply. And once he gets treated as a resident, then he will become a dual resident for India and UK. Because in UK also it's by number of days of presence.
Correct.
And once he becomes a dual resident, then he could apply the tiebreaker test and break the tie to India, is what I would suggest to him. And because I think in absence of a CBDT application or an order from the CBDT for his case, it would be difficult for the income tax officer to give him that relief or to treat him as a resident of India. So he would be treated as a non-resident of India. He'll still be taxable on his pension income in India. The risk is that even UK might want to tax him. And then he will have a problem, right? One will have to get into the UK law or the UK circulars to find out how they are going to treat this. The second question is about a Chinese, the other way around, who came here to India and is stuck in India. And he cannot, will he be taxed in China? Of course, what will be done in China, we'll have to go and find out what is the Chinese position on this. But as far as India is concerned, I would advise him also to go to CBDT and get an order to the effect that he's not a resident because he was stuck here, so that he's not taxed in India on his Chinese income. That would be the way I would approach these questions.
And with reference to the UK, interestingly, like India, even the UK has a similar position where they've clarified that the treaty would be sufficient to address cases of legal residency, and they are not going to give any additional relief or relaxation to people who are stuck in the country.
So in all such cases, it is important to apply to the CBDT. In fact, I also have a live case, where somebody who was on a deputation to Netherlands came to India and then could not ever go back to Netherlands for that year. And Netherlands is going to treat them as taxable because Netherlands, the residency law is exactly like the treaty tiebreaker test. So since they were on employment there, Netherlands is going to tax them and not based on number of days of stay there. And they become residents of India by virtue of number of days. And so under the tiebreaker of the treaty, you can of course tiebreak to Netherlands. But I have also advised them to apply to the CBDT and get a specific dispensation. That would make things easier.
And the second case of the Chinese national who's in India, although this case is where his stay in India would be higher than 183 days because he was in India from April till Jan. There could be other cases where there are shorter stays which are there. So if the stay in India is less than 183 days, then possibly relief could be there. But obviously in this case, it's difficult because travel was impossible. So I think from a COVID-19 and lockdown perspective for expats, there would be a lot of cases where people would be facing issues. And in case of China, at least it could be a case where someone may have a slightly higher tax outgo if they are, say, being to be resident in India and not allowed to, break their residency for China.
But the querist has added some facts in the Chinese query. Sure. And he says in continuation of the China query, he did apply to the consulate, but unfortunately after 2 flights, China shut the country, which is fine. So this is a genuine situation where CBDT is bound to, but CBDT wants you to approach them case by case. Correct. We have all the organizations have represented to the CBDT that this is like putting people to unnecessary problems. But that's the view taken. They said, let people who are affected can approach us and we'll definitely examine it. And they have promised that they will be very liberal about it. So that is how things stand at the moment. Unless you want to go through the litigation route of involuntary stay like Delhi High Court and all that, which I don't think is advisable. Unless CBDT, if CBDT is unreasonable, then yes, of course, the legal route. But I think the CBDT will not be unreasonable. So my suggestion would be to apply to the CBDT.
And also, I think, yeah, I think just before we move on to the next part, I'd just like to say that as you mentioned, sir, that there could be relief from the CBDT, and they could be liberal in giving this benefit. But I think the some of the people who have expressed a worry is that they could end up giving relief where some other country has the right to tax and is levying tax on the income, but people who are otherwise resident in countries like UAE or Saudi Arabia or Oman, or countries where there are low tax rates or no tax rates, maybe the government would intends to kind of not give relief to such people to ensure no non-double taxation.
See, as of today, there is no such reported case from the CBDT,
Correct.
being unreasonable. So let us not,
Yeah.
preempt a situation. Let us not
Correct.
be negative about it.
Yes,
they
definitely.
have come out and said it very openly in all the forums that please approach us, and I don't think, unless we get a reported case where there has been unreasonableness, I don't think we should fear that.
Correct.
Yeah, you may continue, Kush.
The next part, I'll be focusing on the scope and the taxation impact. So we know that a person who's an ordinary resident, his income, the scope of income is global income, whether the source is in India or outside India, received in India or outside India. For a non-resident, the scope is income which is received or deemed to be received in India, and from a source in India, so which is accruing and arising or deemed to accruing and arise in India. The difference between a non-resident and an RNOR is that for an RNOR, in addition to what is taxable for a non-resident, even the income from a business which is controlled from India or a profession which is set up in India would also be taxable. So Section 9 and Section 15. The first question is that what exactly will be taxed? So Section 9 clarifies that salary earned in India is taxable. And what does this mean, salary earned in India? So if the salary is payable for services rendered in India, and also by explanation it's been clarified, including salary which is paid for the rest period or the leave period, which is both preceded and succeeded by services rendered in India, and such pay for the leave period forms a part of the service contract of employment, then this will be considered to be salary which is earned in India. So the logic is that if a person is rendering services or performing the services of employment in India, this should be considered salary which is earned in India. The next question then comes to that when will it be taxed? So Section 15 says that salary is taxable when it's due from the employer or the former employer, whether it's paid or not. So this means that even advance salary, if advance salary is received, even if it's not due, even that is considered taxable. And say if arrears of salary are paid in a subsequent year from a former employer or even a current employer, they would also be taxed in the previous year when they are received, if they have not already been taxed. So in such case, that if they were not due earlier and they were not received, and subsequently they became due or they became paid. So this could be in case of there's a dispute, or there was some performance related bonus which became due and payable after the employment had ended. So all these salaries, which is salary which is due, whether paid or not, salary which is paid in advance, and salary which is received in arrears, these would be taxed in the current year. For non-residents and RNORs, when the salary is due outside India but paid in India, so that's an interesting case where if the salary of a person is not linked to employment exercise in India, would it still be taxable if it's paid in India? So in one case, it was held that because receipt is in India, a few cases it was held that even though it was received in India, although not due in India, it would be taxable in India on receipt. But several other cases, it was clarified by the courts that merely receiving the money in India cannot mean that the amount is taxable in India, simply because it was never due in India and the employment wasn't exercised in India. So mere receipt cannot be the basis for taxation. Another case of the Kolkata ITAT was that a salary was received in the Indian NRE account directly, although the services were rendered outside India. So the place of accrual and receipt itself was held to be outside India. So the ITAT held that just because the bank account where the money is received is in India doesn't mean that the money is received in India, the constructive receipt should be held to be where the money becomes due. So to clarify that the point that where non-residents or RNORs are receiving salary for employment which they've exercised outside India, although they may receive it in India, that would not be taxable in India.
Yeah, but despite that, my suggestion to everybody would be to make sure
Yeah.
that you receive it outside India
Outside
and then
India.
only remit to
Correct.
India.
Yes, avoid
Otherwise,
litigation.
unless you want to go through this whole process of litigation.
Correct. Now we come to the different types of employment models and the tax impact under these models. So one common employment model is called secondment, which is fairly common even domestically as well as cross-border. In such a cases where the economic employer is called the economic employer model, because here under this model the economic employer is tweaked, so to say. So the expatriate employee effectively becomes an employee of the Indian entity, and his salary costs are borne by the Indian entity, who is responsible for all the acts and omissions of the employee. And it could be a case where the salary itself is continuing to be paid by the foreign employer, and the Indian employer reimburses the salary to the foreign employer. So the payment of salary may be from outside, but the salary is in effect and in substance borne by the Indian employer, so to speak. So in such a case, the salary would be taxable only if the services are rendered in India, unless obviously you're a resident and ordinary resident, in which case your global income is taxable. And the Indian employer has the onus of TDS compliance, even if the salary is paid outside India. This fact, I'll discuss it later when I'm taking up the withholding taxes. But even though the payment of salary is outside India by the foreign employer, because the salary is taxable in India, TDS compliance has to be done in India. The other issue which arises is that because the Indian employer is reimbursing the salary to the foreign employer, would this reimbursement be considered an FTS or a pure reimbursement, and therefore would income arise in India to the foreign employee who's getting the reimbursement, and would TDS have to be made? So in this case, there are few contrary judgments, although largely stating that it would be a pure reimbursement which is not taxable, but that depends on the facts of the case. And under the secondment or economic employer model, it becomes very important to ensure that the terms of the contract and the terms of the employment clearly bring out who the actual economic employer of the employee is, whether it's the Indian company or whether it's the foreign company. And subsequently, if the income or the payment which is made to the foreign employer as a reimbursement is held to be an FTS, then the next question is that if there is income arising in India and the employee of the foreign company is in India, does that expose the foreign employer to a PE risk? And can it be considered that is the expat undertaking? Sorry, there's a grammatical error here, but is the expat undertaking any activity for the foreign employer in India? And can there be a service fee or a fixed base fee which is alleged to be created in India? So these are some of the issues which I'll take up later on. The next type of model is a deputation or service model. Here, what happens is that the expatriate employee remains to be on the payroll of the foreign entity, and there is no consideration or not consideration. There is no implication of changing the employer to the Indian entity. So there is no question of the Indian entity being whether the economic or the legal employer. It's simply a case where the employee is sent to India to work for and with the Indian company or the Indian entity, but he continues to be an employee of the US company, and the Indian entity pays the foreign employer a service fee. This service fee could be based entirely on the remuneration which is payable to the employee who is in India, or it could be a mix of that plus a markup or some other fee. But what remains taxable in the hands of the employee itself is the salary which is payable for the service which are rendered in India. Obviously, unless he becomes ordinary resident, where then even if the service component is outside India, the tax would be levied in India. So in such a model, if the employee comes to India and is rendering services to the Indian company, which is not his employer, because the services are rendered in India, employment is exercised in India, the salary would be subject to tax in India. And in this case, the courts have clarified that because the foreign company is the employer, but the salary is taxable in India, even the foreign company or the foreign employer has the onus of TDS compliance, even if the salary is paid outside India. So the foreign employer, when sending an employee to India on a deputation model where it continues to be the economic and legal employer, has to ensure compliance with the TDS provisions. Although there are case laws which say that if the Indian company does the performs the obligation and deposits the TDS on behalf of the foreign employer will not be held in default. In this case, definitely a fixed base or a service fee would be created, depending on obviously on the period of stay of the employee in India. And if a fee is created, then income attribution under Article 7 would follow. But in the absence of a fee, because of the presence in India or Article 5 either may not have a service fee clause, and the conditions of the Article 5 may not be fulfilled, then the amount which is paid from the Indian entity to the foreign employer would be an FTS, and withholding tax consequences would appropriately follow. Another type of employment is where a payroll transfer is there, where this is a case where there's just a fresh employment with an Indian company. There's no question of a foreign employer there. And this could be both short-term or long-term employment contracts. And in such cases, obviously the person is treated to be taxable in India because the employment is entered in India, and the TDS compliance has to be done. Even if, say, the employer is making the payment to the employee's foreign bank account instead of making it to the Indian bank account. Another type which is seen commonly is a dual employment, where, say, a person continues to be an employee of the foreign company, but for a particular period of time is also considered to be an employee of the Indian company. So it's a kind of payroll transfer, but where the foreign company continues to be the employer, and simultaneously the Indian company is also the employer, and both pay salary to the expatriate for the period of service or the part of service which is rendered in the respective country. So, say if a foreign company sends its employee to work for, say, the Indian subsidiary, then the Indian subsidiary will pay the salary for the period that person is in India, and the foreign employer will pay the salary for the period the employee was outside India. And where this would be a normal situation where no short-term employment transfer is there, and the taxability would be based on where the services are rendered. If the expat is a ROR, then obviously the entire income would be taxable in India, and for the part of income which is taxable in the other country, because say if the person becomes a resident of India, then there would be an element of employment which is exercised outside India in the home country. So that income, that salary would be taxable in the home country. So the tax would be paid first there, and then credit of taxes would be available in India. So when an expatriate employee is an employee of an Indian company, obviously the remuneration is taxable in India because it accrues and arises in India. And if the services are rendered outside India, merely receiving the salary in India is not taxable in India, as I already discussed. Also, it could be a case where, say, a person is an employee of a PE or a project office or a project of a foreign company, where either they are conducting their business in India and providing services to an Indian entity. So in these cases, again, the person in India exercising employment in India, his salary would be deemed to accrue and arise in India because the services are rendered in India, including, as the explanation mentions, for the rest periods which precede and succeed the period of services in India. And in this case, if the employee is given additional salary in India, say an employee has a fixed salary for the home country work, and because he's coming to India, then additional salary is there for rendering services in India. It's not just the Indian salary, but the entirety of the salary which will be taxed in India, because the entire salary or remuneration would be earned in respect of the employment being exercised in India. And obviously, in this case, it's not relevant how long the person is in India, because it's a dealing provision, and it's applicable to non-residents as well. So a non-resident's salary which is earned from, say, even 20 days or 30 days of employment in India could hypothetically become taxable, subject to certain exclusions which are there both in the Indian law and in the treaty, which I will come to now. Uh, so this I've already covered it, so I'll not repeat it in same time. So the exemption which I was mentioning for short stays, so where an employee comes to India for a short duration, so there are carve-outs or exemptions which are given both under the domestic law and under the treaty, where in India, under section 10(6), clause Roman 6, uh, an employee who comes to India who's not a citizen of India and his stay in India is less than 90 days in the year, such person's salary would not be subject to tax even if the employment is exercised in India, because the stay of the employee or the person is in India is so short that it won't be fair to tax him in India on a salary. The conditions for this is that the employer of such foreign person who's in India should not be engaged in any trade or business directly in India, and the salary should not be deductible from the employer's income, which is chargeable to tax in India. So if these conditions are fulfilled, the four conditions, then he would be eligible for the short stay exemption. Similarly, under the treaty, looking at the OECD Model Convention, which is where Article 15 is almost similar, I think exactly the same as the UN model and the US model convention. So under this treaty, the exclusion is that if the stay or performance of services and employment in India is less than 183 days, then there would be an exclusion. Interestingly, to kind of avoid abusing this provision, the treaty mentions that the model convention mentions that this 183 day has to be seen not for a particular fiscal year, but for any 12-month period which either commences or concludes in the year. So if an employee is in India and say during FY 21-22, and if say looking at August, the person leaves India in August, he may not be in India for more than 183 days. But if you look back till August 2020 to August 2021, that 12-month period, if he stays more than 183 days, then he would be considered a resident, or he would be not resident, but he would be considered to be taxable in lieu of his salary in India. And interestingly, the Hong Kong Treaty, which Hong Kong Treaty's residency criteria mentions that a person will be considered a resident of Hong Kong if his stay would be similarly calculated. It doesn't mention a fiscal period, but it mentions a rolling period of 12 months and 183 days. So I think similar to the anti-fragmentation, the splitting of contracts provision which has been introduced by the MLI in Article 5, a similar anti-abuse wordings and draft is there in the model conventions for excluding salary income of expats, that if their stay in India during the fiscal year is less than 180 days, but they stay outside India, in India or in the country for a 12-month period more than 183 days, they would still be taxable in India. To avoid people structuring the employment in such a way that they come to India, say in Jan, and they leave in August. So they stay for 8 months, which is more than 183 days, but they still, in neither year, they exceed the 183 day limit. Under the model convention, the criteria for exemption, I'll take that up separately, but just to kind of give a side-by-side example of the difference in the exclusion between the domestic law and the treaty. Other exemptions which are there in the domestic law is that if under 10(6) where remuneration which is paid to an employee who's part of an embassy or consulate is not taxable in India, obviously subject to reciprocity and condition that such person does not have any other engagement or employment in India. And expats are also entitled to ship stay exemption. So that's under 10(6)(8). And under 10(6)(10) is the employees of governments of foreign states, when they come to training for training purposes in India, even their income which they're paid by the government is not taxable in India, but it's exempt in India, subject to fulfillment of certain conditions. The exemptions for perquisites and allowances I'll take up separately, but even those exemptions are available under Section 10. Coming specifically to the OECD Model Convention, so Article 15, 1 and 2 deal with the allocation of taxing rights. So Article 15.1 says that subject to provisions of 16, 18, and 19, which deals with director fees or artists, sports persons, etc., and different categories of income, any salary, wages, and other similar remuneration which are derived by a resident of a contracting state in respect of an employment will be taxable only in that state unless the employment is exercised in the other state. So a similar concept to what is there in India, like if the employment is exercised in India, the income will be taxable in India. But if the employment is exercised in the home country, even though the employer may be of India, it would not be taxable in India. So if the employment is so exercised, such remuneration may derive therefrom may be taxed in the other state. Again, the exclusion which I spoke about in the previous slide is mentioned in paragraph 2, where it says that if the employment is exercised in let's take India as the country, if the recipient is present in India for periods not exceeding 183 days during any 12-month rolling period, and the remuneration which that person earns is paid by or on behalf of an employer who's not a resident of India, and the remuneration is not borne by a PE of that employer in India. So there are three conditions. One, that the employer should be a foreign employer, or at least not resident of India. It should be a resident of the other state, and that other state's resident should not have a PE in India. And if they have a PE in India, that PE should not be paying the salary or should not be bearing the salary which is being paid to the employee in India. And also the employee should be in India for less than 180 days. The OECD commentary and the OECD model has the option, it provides the option to countries to bilaterally change the second condition, which is condition 2B, where it may not be necessary for the employer of the person in India to necessarily be a resident of the treaty partner. He should just not be a resident of India. So it could be a case where the employer is in country A, the employee is a resident of country B, and the person is in India. Even then, they can tweak the wordings of the treaty and allow such condition to be fulfilling the exclusion criteria. So again, primarily the salary is taxable in the country of residence, unless obviously the employment is exercised in India. This works both ways. If an Indian person is exercising his employment outside India, then India would not have the sole right to tax. The employment would be taxed first in the source country, and then India would have the residual taxing rights. The remuneration which is derived from employment. So if the taxation right which continues, even if the money or the salary is received before or after the present. So if an employee comes to India, works in India, and salary is payable to him, but the salary is actually paid later on, that doesn't mean that the amount won't be taxable, because the remuneration was derived from employment and that employment was exercised in India. So the carve-outs from Article 15 are director fees, artists and sports persons, pensions, government employees, and payments to students and teachers in some cases. So if the expat is under these categories, then this Article 15 would not apply to such income which is earned by them. It could be a case where a director is coming to India and is getting a salary as part of his employment, and over and above that is getting director fees. So in such case, there would be two parts of the income of such person, where one would be governed by Article 15 and the other would be governed by Article 16. And in India, one would be considered employment income and the other would be professional fees. Coming to Article 15.3, the 2017 Model Convention amended the wordings of Article 15.3. Earlier, inland waterways were also included as part and parcel of the employment was excluded from being taxed, except in the country where the employment was exercised. Earlier, the previous draft of Article 15.3 said that the amount or the salary would be taxed only in the contracting state, where the place of effective management of the enterprise was situated. Obviously, this Article 15.3 deals with employees who are on board a ship or an aircraft which is operating international traffic. The 2017 draft changed this to say that from POEM, it simply made it residence. So if the person who's operating the aircraft or the ship is a resident of a particular state, the employment income would be taxable only in that state. And the model commentary still allows the flexibility to countries to kind of include inland waterways and substitute residency of the employer to poem of the employer. So this is a carve out from Article 15(1) and 2, where even though the employment may be exercised in a particular country, the salary would still be taxable only in the other country because it's in relation to ships or aircrafts. So now, interestingly, we come to interpretation of certain terms which are used in the TAAs, especially the OECD Model Convention. So, what is an employer? So, this is important from the context of deciding that whether the employer of the person is a person who's resident in India or the foreign employer itself, because as you remember, the condition for the income being exempt in India or being taxable only in the state of residence would be that the employee should be an employee of a foreign employer who's resident in the treaty partner country and not employer who's resident in India. So in cases of secondment where the employee is employed by a foreign company but is sent to work for or with an Indian company, this becomes important to determine that who is the employer in such case. So the clause Vogel has clarified that an employer is someone who an employee is committed to supply his capacity to work and under whose directions and he works. So it's who controls the employee, who directs the employee, that determines who will be the employer. It's not necessarily just who pays the salary or remuneration of the person, but a lot of other factors have to be considered to decide who is the employer. A key consideration as per the OECD's commentary is that a key consideration is that which enterprise bears the responsibility and the risk of an individual's work. Because if the foreign company is eventually liable for the acts of the employee in India, they will be considered to be the employer. And if merely the Indian company is directing the employee, controlling the employee, supervising the employee, deciding whether to keep him in employment or terminate the employment, then it would be the Indian company who would be the employer and not the US company. The OECD commentary distinguishes between a contract of service and a contract for service, where if the foreign company is providing services to the Indian company through the employee, it would not be considered that the Indian company is the employee of the person, but the foreign company. But if the Indian person has a contract with the Indian company where he is giving services to the Indian company as an employee of the Indian company, then the Indian company would be considered to be the economic employee or the employee for the purpose of the treaty and not the foreign company. And yes, so where the performance of the duty is and who's directing those actions of the employee, whose policies the employee has to follow, who is the supervisor of the employee. So there are various tests which have been laid down by the Indian courts, which talk about the fact that whether the employee is a servant or an agent of the person being looked at as the employer. So if the employer exercises supervisory control in respect of the work, then it would be considered the employer. The higher the degree of independence and autonomy which the employee has with respect to a particular person being considered to be the employer would determine whether or not he's in fact the employer. So if the employee is accustomed to act under directions and guidance of the foreign company, and the Indian company merely accepts whatever the Indian employee does, irrespective of whether they decided the action to be taken or not, then obviously it will be considered that the employee is the employee of the foreign company. But if the foreign company does not have too much role of supervision and direction, and that is left to the management or to the persons in the Indian company's employment, then obviously the person will be considered an employee of the Indian company. So as I said, economic employer versus legal employer is a big distinction which has to be made. The key consideration will be on who bears the risk and responsibility of the results, which is what the OECD model commentary says. There are several judicial precedents, and these cases are relevant not just for deciding whether the employer is the foreign company or the Indian company, but a follow-on implication of that is that if in fact the Indian company is is the employer, it could have an impact on the whether the payment made by the Indian company to reimburse the foreign employer, who could still be the legal employer, whether that payment is an FTS or it's just a reimbursement. So in these cases, these two issues were in most cases they were taken up together. And what comes out from these cases is that it's very important that the terms and conditions in the contract for employment clearly bring out who exactly is the employer of this employee who's coming to India, or say from Indian company's perspective is going to work outside India, because a loosely worded contract could have implications which are not foreseen and could expose the foreign company to FTS or PE risk, and it would be difficult for the Indian employer to justify that they are not the employer or the foreign company is not the employer if the contract is not worded properly. So the factors which are important are obviously who is supervising the employee, who has the right to terminate the employee services, whose policies are being followed, who has the right to call back the employer or reject the employee. So and I think on this point, I think Sushil sir has mentioned earlier to me when we were discussing that he had some comments to make because this is an important point on taxation. So I think Sushil sir, if you would.
No, I'll make a very quick comment, Kush, because we are running behind time. I see that you have literally quite a few slides left, and I think we have dwelt quite long on this one topic. But anyway, what I want to basically say is the whole game here rests on the terms of the agreement or secondment. And Centerica is a classic case in hand which went against, and that was purely because of bad facts.
Yes.
So one has to look at Centerica to understand what not to do. And you will have to take care to see that the terms and the agreement in letter and spirit are in such a way that the economic employment is very clear. There should be no confusion. So that's all. I think with that, Kush, I will request you to move to the other issues peculiar to because this I think we have the slides are going to be hopefully distributed. I'm not sure.
Yes. Yeah,
but yeah, so I think this point we have made. So let's move to the next point, so that the viewers get the
coverage
benefit of the entire and we also need some time at the end.
Yes, sure. So I'll just quickly run through these, which I feel are less important as compared to the other points. Another point is important is determining or interpreting where employment is exercised. So there are several ways in which to do this, but the primary way of doing it is the physical presence. And there are several cases, both Indian and foreign, where different opinions are there. But normally the place where a person is physically present when performing the services would be the place where employment is exercised. Another important point is that to determine whether the treaty will exclude the taxation from the source country and only allow the residence country to tax is whether or not the payment of salary was borne by the PE. There are several cases and several points which are there. I'll quickly run through them. If the payment of salary can be allocated to the PE, so if an apportionment has to be done or allocation has to be done, and that salary can be allocated to the PE, then it will be considered to be borne by the PE. If the PE is commercially liable to or actually pays the expenses, or if the payment or the expenditure has a direct and proximate relationship with the business receipts of the PE, whether or not the PE pays it or it's reimbursed, or whoever actually pays it is not relevant. What is important is who has the proximate relationship and the nexus with the business receipts would determine whether the PE bears it or not. It also includes cases where actual deduction may not be taken, either because a presumptive taxation scheme applies. So actual deduction is not important. What is important is availability of deduction. So if under normal circumstances it could have been deducted, it would be assumed to be deducted. Coming to the next point, next part of the presentation, looking at specific parts or components of the salary which are how they are taxed, starting with per diem allowance. So looking at section 1014, where read with 2BB, where there is exclusion or exemption which is given for allowance which is granted to meet expenses and perform the duties of employment. So this often happens when a person is traveling to another country from away from the home country. He's given an additional allowance. So whether or not this amount will be taxable as part of salary or not will depend on several factors. Most importantly, that it should not be a fixed lump sum payment which is given irrespective of how much is spent by the employee. It should be kind of given only to meet expenses which that person has to meet because of a change in place of employment. And there is a case, Supreme Court case, where it says that ideally there should be evidence to show that the amount which has been allowed to the employee was actually spent. And the amount, so it should not be an ad hoc reimbursement, it should be an actual reimbursement or an actual allowance. But if it's difficult to have evidence, then whatever best evidence is available, including self-declaration, would be enough. And this is relevant from both an outbound and an inbound perspective, because the taxability would arise nonetheless whether the person is working outside India or in India. There are a few judicial precedences on this where if the person is spending money which is a reimbursement of the money which he would have required to spend, it will be considered not taxable. And I think there was a question on expenses for transfers. So at least from the perspective of the employee, if there's a transfer in employment and say the shifting expenses, etc., are borne by the employer, that would not be taxable in the hands of the employee. Next, we come to tax equalization. So in this, there are two types. There is a simple tax equalization which works similar to a tax protected contract, and there's a hypothetical tax scenario. So tax equalization, simply how it works is that, say if an employee is working in a country and his net post-tax salary is $65,000 rupees, whatever we want to take it. If he's going on assignment to another country, then what the employer would do is that ensure that his post-tax salary remains the same. So even if the tax in the other country is higher, then he would be given a compensatory payment, which would ensure that his salary stays at 65,000 instead of reducing to 60,000, which example is given. So in those cases, these are important aspects which are considered, especially management level expatriates, because they don't want to kind of give up on their employment benefits or their the amount of money which they're getting. So the onus goes on to the employer to bear that cost. Hypothetical taxes are an interesting strategy which is deployed to kind of keep an employee tax neutral. So expatriates are then paid. They are paid a particular amount, which after deducting a hypothetical tax. So it's not really a deduction, but what happens is the salary is calculated after making a notional deduction for the hypothetical tax that they would have paid in the other country, and the employer in the host country uses this reserve to discharge the taxes. So I'll come to the example where, for example, say an employee has a gross salary in the home country of 100,000, and the normal tax rate was 25%. So his net of tax salary was 75,000 after the tax in the home country. So, and when the person is coming to say work in the host country, he's getting an additional allowance for the assignment of say 25,000. So the total salary which should be taxed, he should be getting as per his requirement would be the original net 75,000 after the home country tax plus 25,000 in the host country minus the host country tax. So how this works is that the hypothetical tax is deducted before, not actually deducted, but notionally deducted. And the net salary which is considered for the host country purpose is 75,000 plus the salary which is a special allowance, and then the incremental tax is added. So if you look at row D and row F, that is 25,000 plus 7,000, that becomes equal to the tax in the host country. The employee continues to receive 75,000 plus the net of tax amount of 25,000. And if this isn't done, if there is no hypothetical tax done, then the amount which is taxable in India increases from 100,000 to 125,000, which increases the tax burden. So hypothetical taxes are not a concept which are part of the Indian tax law, but because of cross-border or expats coming to India for work regularly, this concept has been introduced into India through employment contracts of expats. And what the courts have held is that whether or not the hypo tax is actually a salary or a perquisite is not, it does not matter, because this amount was never due to the employee. So what is taxable in India is something which is due to the employee. Since this was never due, it was just a notional calculation which was done to equalize the taxes and to ensure the employee doesn't have an adverse position through coming to India to work. This amount cannot be treated as part of the salary. And what will be taxable would be the amount of salary actually paid plus whatever tax was paid. And also the court clarified that the exemption for under 1010cc, where the tax which is borne by the employer and as is considered a non-monetary perquisite, this would extend to both the hypothetical tax plus the tax which is borne by the employer. Obviously, if 1010cc is availed by the employee, then the tax which is being paid by the employer on his behalf would not be allowed as a deduction for the company or the employer. Another point is that there are a couple of cases which clarified hypo taxes. They said that it's not relevant where the hypo tax is deducted from, whether it's deducted from the base salary or from the perquisites or from the value after the base salary. But there are implications for this, because if, say, the base salary itself is reduced, then that has an impact on the PF contributions or the HRA calculations. So although it may not have an impact on an overall basis from the tax, it may have an impact on the calculation of perquisites and PF. Coming to social security contributions, this is an important aspect for international workers, especially because for a lot of foreign countries which are more developed, social security contributions and retirement benefits form a big part and a major part of the remuneration and the benefits which an employee is given. So the social security in India is governed by the PF Act, as we all know, and it was modified in November 2008 to extend its scope to even international workers. So the EPFA will apply to expats who are working for an Indian employer, to which the EPFA applies. So if the person is working in an Indian company and the PF Act applies to them, they would be considered within the scope of EPFA. Similar to the DTAAs which India has, a lot of countries, including India, has social security agreements where an expat can, if the expat is coming from a country with which India has a SSA, they can obtain a certificate of coverage, and they would then be exempt from having to make contributions in India to the PF. The taxability of PF contributions is similar to the salary, and we know that now there have been some changes to the what part of the contribution is taxable and limits to the contribution, including interest. So those would similarly apply to even the expats who are in India covered by the PF law. It's interesting to note that if a expat worker comes from a SSA country, then he can withdraw his accumulated PF balance after ceasing to be an employee of the Indian country. So if, say, he comes to India for 3 or 4 years and then leaves India, then he can withdraw his PF balance and take it outside. But if he's not from a country with which India has an SSA, this money would be fixed and it would be unavailable to him till he attains the age of 58, or under the normal conditions which are circumstances which are available for people to withdraw their PF balance, which is medical expenses or things like that. From a perspective
Kush, another 5 or 6 minutes, please.
Sure. From the perspective of taxability of these contributions, so there's a clear judgments which are there that say that if the contributions are mandatory and they're diverted from the employee salary by overriding title, and the employee never had the right to receive them, and they're part of a government statutory compliance scheme, and all employees have to make such contributions, then they would not be taxable in the hands of the employees. But if they're part of, say, a company formed scheme and not they're voluntary in nature, then they would not be then they would be taxable in the year in which they accrue. The guiding principles for this is that the contribution should be compulsory and mandatory. They should be paid or contributed before the employee actually receives them. So it should be, the employee should be getting the salary net of these payments. So in such cases, even the social security contribution would not be taxable in India. And this obviously refers to the contributions which are made in the home country of an expat living in India. So if the foreign employer continues to pay the salary in India and contributions are made outside India, then those contributions would not be taxable in India. Coming to the employer's contribution to the pension funds or pension schemes, again, there are similar judgments to say that that since this amount which is not due today, it cannot be taxed today, and it vests at a much later date, because there are certain conditions whether or not the pension will be paid if the person stays an employee for a certain period of time. So the right to receive this money is not fixed today. You don't know whether or not you're going to get it or not in the future. So you cannot tax it today. However, it's clear that it would be taxed at the time of receipt if it relates to the services which are rendered in India, subject to the treaty provisions. Pensions obviously are not covered by Article 15, but by a separate article. So that particular article would apply to determine the taxability of pension income. There are certain other benefits where interesting case of Yoshio Kubo was there, which had several issues which were dealt with, including payment of medical insurance by the employer for the expat employee, payment of consultants fees for filing the employee's tax return, and even the tax refund which was received on excess payment of tax for that employee's salary. So these were considered not to be taxable in the hands of the expat employee. Also, interestingly, in one case, in this particular case, the refund was received after the employee had left the country, and so the court held that the employer had borne the tax, so he could receive the tax back, and it would not be considered income for the employer itself. Also, ESOPs are an interesting and important part now, especially with a lot of cross-border employees working for foreign headquartered MNCs, which are issuing, heavily remunerating their top-level employees through ESOP options. So we all know that ESOP is taxable when the shares are allotted. There's a decision. There are several decisions, including Bharat Financial Inclusion, where the tax arises when the shares are allotted, although the valuation is to be done when the option is exercised, because there could be a gap between exercising the option and finally allotting the shares to the employee. And sale of shares would be subject to Article 13 and capital gains, and not to employment income. From a taxation perspective, it's clear that ESOPs, if the salary or the salary was taxable in India because services were rendered in India, the ESOPs which got vested, or which the employee got the right to exercise or have the ESOPs, was linked to the employment exercise in India, those ESOPs would be taxable in India. And if there could be a case where an employee has some part of his stay in India and some part of his stay outside India where employment is exercised, then proportionately the ESOP would be taxed. So the part of services rendered outside India would not be taxed, and the part of the period of services rendered in India would be subject to tax. And this would be based on the physical proportionate number of days. The OECD commentary also has a similar opinion, although it's interesting to see that in some cases where the employment is exercised for a very long duration over multiple countries, there is some clarification from the OECD saying that you should ideally then look at only the nearest part of the employment and not the entire part, because it would be very difficult in allocating a share to every country where the expat had worked, if it's say 5 or 6 countries over 7 or 8 years. In respect of the ESOP tax deferral, which is now available to eligible startups, even expats will be eligible to that if, say, an expat is working for an Indian headquartered MNC, which is eligible startup, and the Indian company is issuing ESOPs to such employees who's resident in another country. So even that benefit will be available to that outbound expat. Coming to withholding taxes and other issues, if
I think
the question is that
Kush, time, Hina, Prerna, what is the time available now?
I think it's
So
15 minutes.
Sushil sir, actually it's 15 minutes, and Unfortunately, there are a lot of questions.
No,
which
there are
people-
only 2 questions because
No,
others we
that
have
is what is in
answered.
the Q&A box, sir.
Yeah.
Generally, people would, want to
Okay,
have some
so-
interaction as well.
So fine. So what we can do, Kush, because the presentation is anyway being circulated,
Yes.
because I think we have covered most of the issues which are relevant, and the TDS issues are covered in this presentation. So with
Correct.
that, then we can possibly, unless you have anything specific, any particular point that you want to not miss out. Otherwise, I think we have covered every possible aspect. So let's
Yes.
then go to the Q&A. Should we do that, Rajesh?
Yes, agree,
Yeah.
agree, sir. Let's go to the
Okay.
Q&A.
Okay. So now there are, as I see, there are 2 new questions which came after whatever we have answered. One is a question where, in case of work from home, when an employee is working from India for a US company online, where would the service be considered to have been rendered? Yeah, Kush?
Yeah. So I think this would be clear that at least as far as India is concerned, even the US India DTAA is concerned, the employment would be considered to be exercised where the employee is physically present. So if an
Absolutely.
Indian is working for a US company from India, he would be considered to be taxable in India, not in the US.
Yes.
And a lot of US companies may choose to have a contractor-contractee relationship rather than employer-employee relationship, because from a social security perspective and a liability perspective, they would prefer to insulate themselves from those contribution requirements and those laws. So maybe
there could be a slight twist, Kush, if in this case, if that fellow can
Yes.
contend successfully that I was stuck in India because of COVID and could not travel.
correct.
And
I
then,
think that would be,
that is a separate set of issue
Yes.
altogether. Yeah.
that would be interesting if the person was originally employed in the US and
Yeah.
came to India, or even
Yeah,
if he
yeah.
was supposed to leave India for the purpose
Yeah.
of taking
So
up
on
employment
those
abroad.
facts, those facts may change things.
Yes.
He can contend possibly. Okay, the next question which is there on the table is, because of section 40 small a small 5, is there an option whether to take 10 cc benefit in computation of the employee, or 10 cc is a mandatory provision?
So this would depend on how the tax is or the contract is worded, because if the employer is supposed to bear the tax on behalf of the employee, and the employee doesn't want to pay tax on this part of the so this part is supposed to be an exclusion from the employee's salary, then there would be no option to the employer. But if the employee is willing to kind of take this as part of the salary and bear the tax thereon, then it would become more of a TDS than tax borne on behalf of the employee. And then obviously it would become a salary payment. So it would depend on what the contractual relationship or the agreement between the employer and employee is. It could be both ways, but if it's borne on behalf, then it would be 1010 CC would apply and 40A5 would disallow the expense.
Right. Any other questions anybody would like to raise? If not, then I would like Kush to cover this slide of foreign asset disclosures. But first, let's wait for a minute or two to see if there are any questions coming up. Ina, Prerna, any questions?
As of now, sir, there is no more questions.
Requesting members, in case anybody wants to have any questions, please raise your hand so that we can allow the people to speak.
Now the house is open for questions. Somebody can raise a hand and...
Ramnath Rao has raised.
Okay.
Ina, can you allow him to speak?
Yeah.
Yeah, sure. Yes, Ramnath.
Yeah. Thank you for letting my question in. I have a question which is a little unrelated to the taxation, but I'm keen to know if all these expats who are living in India are allowed to invest in Indian equity markets. So I'm just curious to know about that.
Sure. So that would be a question for FEMA, which is for
Rajesh Shah is here, so we don't need any other expert. Rajesh, please answer that query.
See, sir, the person who has come to India, although he's an expat, because as said by Kush, he's holding the foreign passport, but under FEMA 2V, he becomes an Indian resident once he takes up his employment. Other than the immovable property, where the number of days and all those criteria has to be taken into consideration, but for those investments and all, immediately from his salary account, where the salary is credited, he can make all the investments. Unless and until there is a restriction, like a ETF or a sovereign gold bond, where there is specifically mentioning where the NRIs cannot invest, still they will be eligible because they are now resident of India. This is the reason, Mr. Ramnath, they are allowed to invest into the equity market or whatever debt mutual fund what you are referring to.
Okay, thank you. But where can I get more details about it if I may want to?
It's on the RBI website. If you can go to the FAQ, you will be seeing that foreign citizens who are resident of India, the whole detailing is over there on the master direction or the FAQ.
Okay, thank you so
Thank
much.
you, Rajesh.
Thank you.
Or you can also look at the FDI policy, because this would be covered under that document, or the master direction on FDI, which is there.
Okay. Any other questions?
Rajesh sir, based on this question, I have a question to ask you and Sushil sir. That if say in this question which was asked, that and you said that the person taking up employment in India can becomes a person resident in India, irrespective of the state, and can invest in Indian equities. So if say it is being considered under income tax law that the economic employer of this employee is the foreign company, can it still be said that he's come for employment in India, or is it in connection with employment or for the purpose of employment? So would there be an interplay between the two, in your opinion?
Okay. So Dilip Bhai has taught me one thing: when you're looking to FEMA, don't look to the income tax.
Correct.
As per FEMA, the moment you come for the employment, you become a resident of India. And the most important thing, Kush, is on which visa they have come.
Yes.
If they have come on a tourist visa, even they are employed, then there is a wrong. They cannot get employed. They have to come on an employment visa. So that care one needs to take care. Regarding the taxation, Sushil Bhai will be able to tell you on the thing.
No, what he says is right. I think the taxation part you have already covered, that the economic employment. I think what Rajesh said is perfectly correct. So if there are no further questions, I think you can quickly cover this foreign asset disclosure.
Sure.
Is there any questions or should I ask Kush to cover this one slide?
We do not have any members who have raised
sure.
hands.
So
I
in the
believe,
meantime,
Kush, you
so can you please cover this foreign asset disclosure, because that is very important.
Yes. So from the perspective of disclosures of foreign assets, this is important for employers as well as employees of expat employees. From 2011-12, FY 11-12 onwards, the income tax law requires disclosure of all foreign assets or foreign assets and income as part of the ITR. And the implications and penalties for not doing so or missing out on a particular disclosure are extremely adverse and draconian, because the black money law applies in parallel to the Income Tax Act, and there is rigorous imprisonment provisions under the black money law. So it's very important that when a person is coming to work in India and he expects to stay in India for 3 or more years, or he's been a resident, he's going to become an ROR during his presence in India, he should or she should be extremely careful about properly disclosing all foreign assets and interests, which include foreign bank accounts, even foreign bank accounts where you are not the holder but you just have signing interest or signing authority. Even that has to be disclosed. Foreign depository accounts, custodial accounts, insurance or annuity contracts. So there are shareholdings, directorships. A lot of disclosures are there, and if even a small disclosure is missed out, it could have implications which are disproportionate to what is not disclosed. From an employer's perspective, it could be if the Form 16 does not mention the income from all these assets. Say if there are shares which are held in foreign countries and the dividend from that, or if there is some debt which is held, debt security which is held and the interest thereon is not taken as part of the Form 16, then the law could even go so far as to include the employer as someone who's abetting the the non-disclosure or the concealment of foreign assets. So from the perspective of expats coming to India, it's very important that the FA schedule and the black money law is taken care of, and proper information and knowledge is there within the employees and the employers that what disclosure they make.
Thank you, Kush. Rajesh, there is one query for you on the chat box, on the question box. If an Indian person goes outside India on a secondment, does he need to change his savings bank account status to NRO or NRE?
Okay, so secondment is a concept, Sushil bhai, for the purpose of the income tax. But under FEMA, he is going for an employment.
Yes.
Yeah.
So the moment he goes for an employment, only care needs to be taken whether he will be getting salary from the Indian employer also or only from the foreign employer. If it is only from the foreign employer, then no problem. But if he is going to receive from the Indian employer also, then he cannot convert from NRO or NRE.